and welcome to our illustration of payroll accounting. Obviously, this is a very, very common task that the accounting department will deal with every company. And it's pretty simple, and we'll try to show you why it's pretty simple in this illustration. But there is a lot of things we need to account for. So we have to see these and place them into a context and a paradigm. Okay, so let's look at the facts in our case. And I should say, this is a case that has one employee. But other than that, this is pretty representative of what payroll accounting is. At each company, there will be, many more employees, and there might be many more aspects to their compensation package, but they're all going to fall into a similar paradigm, and we're going to build that paradigm now. As of April of 2024, Poultry Corporation has one employee. Salary for that employee is $120,000 or $10,000 per month, because we do payroll obviously on a monthly basis when the employees are paid monthly. The fringe benefits for the employee, the fringe benefits that the company offered to them when they agreed to join the company. The first group in the fringe benefits is the retirement plan. This particular company offers its employees the option of contributing retirement funds up to 5% of his or her salary to the plan, and then the contribution is then matched by the company. The employee in this case has chosen to contribute the entire 5% of her retirement plan each month. You should do the same. These are wonderful fringe benefits for all employees. This is what you may or may not know, you may or may not have heard of as a 401k plan. A 401k plan is a defined contribution retirement plan, where the contribution of the employee into the retirement plan is defined by some formula, in this case, 5% of the employee's salary, and then the company provides some sort of match. Sometimes it's a one-for-one match. Sometimes it's more than that. Very, very good opportunity to grow your retirement funds. And this is a very common part of retirement packages in this era. You likely will have one. In addition, a fringe benefit is that the company helps with insurance premiums. This, again, is a very common aspect of compensation packages. In this case, the company pays 80% of the employee's medical insurance premiums and life insurance premiums. The employee will then have to pay the other 20%, but that's a nice deal. The medical insurance premium totals $100 per month, and the life insurance premium totals $10 per month. Keep these in mind, and I will summarize them in a moment together with you. In addition to insurance premiums, the company conducts some withholdings. These are withholdings that will be remitted to an external group. Income tax withholdings are at the following rates. The federal income tax withholding is 25%, and the state income tax withholding is 7%. When you fill out your employee forms when you're onboarded to a company, those questions they ask are going to help the company to know what percentage to withhold of your salary. Theoretically here, the federal income tax rate for the employee is going to approximate 25%, and the state income tax rate for this employee is going to approximate 7%. So the amounts will be withheld from the check, sent to the government by the company, and then when you file your tax return, that's why sometimes you get a tax refund or only have to pay a little bit, because your tax has been withheld by the company and paid to the government already. FICA, Federal Insurance Corporation Act withholdings include Social Security withholding, your Social Security tax of 6.2% of your salary, in this case, 6.2% of this employee's salary, and Medicare withholding of 1.45% of the employee's salary. Unemployment taxes. State unemployment tax for the state that this corporation resides in is 5.4% of the first $7,000 earned by each employee. That must be paid by the company. Federal unemployment tax is 0.6% of the first $7,000 earned by each employee, and that must be paid by the employer as well. Okay, and that's going to be that's all of the facts we need to know around the employee contract for payroll accounting. And this will be done every month. Again, at companies, you'll have a lot more employees and you'll have some more aspects of, for example, fringe benefits. But you certainly have examples of the classic genres of transactions and considerations that must be accounted for under payroll accounting. So required in our case is to prepare the appropriate journal entries to record the company payroll for April at Poultry Corporation. Note that the employee's cumulative wages do not exceed the relevant wage bases for Social Security, but the employee's cumulative wages do exceed the relevant unemployment wage bases at the end of April. Okay, now, first thing I want to do with y'all is summarize what we have just read. And here it is. So we have Poultry Corp, and these are my notes that I was taking while I read the facts of the employee's contract. The salary of the employee is $120,000 annually or $10,000 a month. If you have a job or have had a job, think of this in terms of the context of your world. I think you're going to start to make a lot of sense of what all those numbers are on your payroll stub. The fringe benefits. The fringe benefits, the first one is the retirement plan, or as I said, the 401k. That name comes from the tax code, the Internal Revenue Code, that prescribes the tax treatment for retirement plans. And you will learn about that in your tax course upcoming in your curriculum. You learn all about it. Under the retirement plan at this company, the employee contributes 5% and the employer matches. Again, do this. It adds up. It adds up. And when you're ready to retire, you'll have a nice nest egg upon which to retire if you have contributed maximally to your retirement plan. The insurance premiums, they're part of the fringe benefit package at this company. And the details are that the company pays 80% of medical premiums and life insurance premiums. And then the employee pays the other 20%. Below the facts of the contract, the employment contract, I provide the amounts this year under our contract with our insurance provider. The medical insurance premium for the employee is $100 a month or $1,200 a year. And the life insurance premium is $10 a month or $120 per year. Now we have the withholdings we need to consider. That's sort of the end of the fringe benefits as we think of them. The first aspect of the withholdings is income tax. The federal withholding is 25% of the employee's salary. Again, whenever you see these things, add that in. 25% of what? In this case, 25% of your salary, the employee's salary. State withholding is 7% of that employee's salary. And then FICA. So the FICA, the two aspects of FICA are Social Security and Medicare. And Social Security is 6.2% of the employee's salary. And Medicare is 1.545% of the employee's salary. And the point here under public policy is that you are paying in to this Social Security system and the Medicare system, and your funds are currently being used to fund the current retirees in the country. And then the point is that when you retire, similarly, the next generation will be paying this FICA, and they will pay for your needs in retirement. Unemployment taxes, they are also withheld, or in this case, they're also paid. The state unemployment tax rate is 5.4% of the first $7,000 for each of our employees, paid by the company. The federal unemployment rate is 0.6% of the first $7,000 of each employee's salaries, paid by the company. And the point here is that if the employee loses the job, they can file for unemployment compensation, and that unemployment compensation will come out of the funds paid by all of the employed employees of the state or the nation. And then the public policy vision is that you will get another job. You will have unemployment compensation to carry you through and not leave you homeless. And then when you get another job, you'll continue to pay for the unfortunate few others that lose their job. And then required, I wrote down, prepare the appropriate payroll journal entries for April. Okay, now, when you read about this in your book, I feel like they did a great job of preparing the journal entry, but in a paradigmatic form, a paradigm for the components of the journal entry. I hope that what you'll see is that I've tried to do so in the style that I prefer. I think you might, but I encourage you to do the journal entry in a way that helps you to understand exactly what you're doing, exactly why you're doing it, and then you'll be a very accurate CPA or accountant. Okay, so there's the facts, and now let's work this particular case and develop the journal entry that we're going to add into the accounting system, and also to indicate the amount of cash that's going to be sent to the employee and sent to the insurance companies and sent to the 401k investment corporation and sent to the state taxing authorities and the federal taxing authorities. Okay. So at this point, I would love to see you pause the video, if you haven't already, and work this case. And then my hope is when you get back, you will simply be, if you even choose to watch my video, you'll simply be verifying that, yeah, I got this. Okay, so I will see you in a moment. All right, welcome back. I hope welcome back. I encourage you to challenge yourself on these things. All right. So I'm going to develop the paradigm the way I develop the journal entry and take care of payroll and pay it. The first part is the employee paycheck with the employee portion of all deductions withheld. So step one is that the salary and wage expense is going to be $10,000. I'll show you what that note says on the side there in a moment. This is the total amount earned by the employees. So I'm going to have a note for you on the right side of the journal entry. Hence, we're increasing the expense for the company and therefore simultaneously decreasing stockholders' equity by debiting the temporary expense account that will be closed to retained earnings or shareholders' equity. There are those withholdings. And I wrote you a little note. The cash is the net. And then don't we know that? I'll come back to that when we're done. Okay, so the federal income tax withholding payable is a liability account, a payable account, and it's 25% of the $10,000 salary per the requirement. The local income tax withholding is $700. I apologize. That should say the state income tax withholding. Very much apologize there. Not sure. State withholding, income tax withholding payable of $700 or 7%. Social Security taxes payable are 6.2% of the salary. So 6.2% times 10,000 means the company has to send $620 to the federal government on behalf of this employee, which is 6.2% of the $10,000 they earned. Similarly, Medicare taxes payable is $145, 1.45%. Again, we are crediting a liability account to increase it. Medical insurance premium, well, the total premium is $100, and the employee is on the hook for 20% of it. So the employee has to contribute 20%, $20, 20% in this case, $20. The life insurance payable, the monthly amount is $10, and the employee has to contribute 20% of that, or $2. The retirement plan payable is $500, withheld from the $10,000, 5%, and it'll be sent into, when it's settled, we will credit cash and debit that retirement plan payable. And when we credit cash, we'll be sending it into the employee's investment account. And then cash. Notice, cash is the net of all that. Your total salary was $10,000, but then a lot of stuff had to be withheld. And so there's that's why I have that note on the right. The cash is the net. And again, don't we know? If you have a job, you know, oh man, why is all this money out of my check? Well, that's why. All right, and that's the employee's pay, netted by all the various withholdings from the employee. The next section of the journal entry is the employer portion of the fringe benefits. Now, I have some notes written in ink there you're going to see in a moment. Hold off on those. I'll discuss those in a moment, and you'll see why I felt the need to emphasize this for you. Okay, here is the journal entry. I'm going to take it one at a time. The medical insurance payable is $80. Well, how did I know that? Well, I know the monthly insurance premium is $100, and the company has to pay 80% of it. The employee only has to pay 20%. So the company, we have to send $80 for that employee's medical insurance. Same thing, $8 for 80% of the $10 monthly life insurance that is paid on behalf of the employee by the company. Retirement plan payable, remember, the company matches the employee contribution. And so the total amount that the company has to pay, the employer's portion of the fringe benefits, is 80 plus 8 plus 500, or 588. Hence, the way we do this journal entry, and more importantly, the way we know what to send, is we establish those liabilities based on the details of the employee contract, and then the resulting expense is the sum of them. So with each of these, we have a cash payment going to these entities, the entities underlying these amounts. You see the difference there? Here, we determined these amounts, and then this was the net logically, because we wouldn't have known this without these amounts. In the case above, we knew this. We knew that the employee's salary is $120,000 a year, or $10,000 a month. We calculated these, just like we calculated that. And then the net that we didn't know until we worked all this up was how much cash to send to the employee. And then there is the employer payroll taxes. Notice we took care of the employee payroll taxes above. Now it's the employer's portion of them. Same thing on the logic. We're going to establish the liabilities, and then the expense will be the sum of what we have to pay. Social Security taxes payable. The company pays that same 6.2% that the employee paid. Medicare taxes payable. The company pays to the federal government that same amount the employee paid, that same percentage of that salary. State unemployment tax is 5.4% of the first $7,000. That's paid by only the company. Federal unemployment taxes payable is 0.6% of the first $7,000 earned by the employee, and that's paid by the company as well. And so once we've established these liabilities, we know how much of the payroll tax expense results from that. And so obviously, and so the expense for the company related to the employee is going to be the sum of those three. And I chose to use that separate account name, but it's all going to go to the expense line. on the financial statements. And then we have the various liabilities established. And that is payroll accounting. And again, take a look. Make that make sense. Make these three categories of what we're doing make sense. And you're going to be you already will be qualified to manage the payroll department, to carry out payroll accounting. You could even do a business in there is a vast industry of payroll accounting. Every company needs payroll accounting. You're ready. The only difference between this and the real world is there's a lot more employees usually and a few more categories within these general categories, a few more particular lines. All right. Thank you for your attention and have a wonderful day.